should you take a small mortgage into retirement? Some people say yes, because there's tax benefits. Others people say no, you should have lowest expenses possible as you go into retirement. So what's the right answer? Well, it depends. And in today's video, I'm going to walk you through both sides of the issue so that you can understand what makes most sense for you. Hey everybody, I'm James Canole, founder of Root Financial Partners, and I'm here to tell you what you need to know to create a secure retirement. I'll get asked the question a decent amount of, should I take a small mortgage into retirement, is the way it's typically phrased. Now, there's two different sides of the table here, two different parts to this, and I want to break each down one by one. In the first side, when people are talking about bringing a small mortgage into retirement, they think that there's some tax benefits to that. Of should I maintain my mortgage, not too big of a mortgage, but maybe any mortgage, in order to be able to take advantage of the tax benefits to lower my taxable income in retirement. So let's start with that aspect. To do so, let's understand first how deductions work. So when you are deducting things on your tax return, the IRS allows you to deduct things like mortgage interest, state and local taxes being property taxes typically, but those are capped at $10,000 per year. So the combination of state and local taxes, you can't deduct more than $10,000. So it's mortgage interest, state and local taxes up to a cap of $10,000, charitable deductions, and then some other things, medical expenses over certain thresholds, and a couple other things as well. So what the IRS says is if you add all of these things up, you can deduct those, or you can just take a standard deduction. For 2022, that standard deduction is $25,900 if you're under 65. If you're a little over than 65 or both spouses are, it's a little bit more, but for married, filing jointly, $25,900 is the standard deduction. So if you add up things like mortgage interest and charitable giving and state and local taxes and anything else, and it's above $25,900, well, great. You can fully deduct those things. It's called itemizing your deductions. If it's any amount under $25,900, you just take the standard. So you get your pick and you're going to take the higher of the two. So for people asking, should I take a small mortgage into retirement because of the tax benefits, well, we have to understand, are there even any tax benefits involved? Let's assume you take a mortgage of $100,000 into retirement. So you've paid most of it off, but you're delaying paying off the remainder for the tax benefits. Well, even at a 4% interest rate, you're only going to have about $4,000 of interest on that mortgage in that year. So if you look at your total itemized deductions, you're not going to have any more than $10,000 in state and local taxes that you can deduct. So let's assume that you have the full amount. So that starts at 10. Then you have $4,000 of mortgage interest, at least for that first year. Then, unless you have a significant amount of charitable contributions or medical expenses or any other deductions, you're probably not even going to hit the cap of $25,900, which is what your standard deduction would provide for. So unless there are those charitable gifts or those other things, if you're trying to take a small mortgage into retirement for the tax benefits, for a lot of people, not everyone, but for a lot of people, the answer is a simple no. You're not even going to get to take advantage of those tax benefits, so it doesn't necessarily make sense to do so. So that's one side. Now, if your mortgage is $500,000 and you're paying 4% interest, that's a different story. Now you're paying $20,000 per year in interest. You should not ever have a mortgage just for the interest deduction, but it helps to alleviate some of the burden of a mortgage balance. And in that case, you likely would itemize, depending on your other deductions. So it depends upon the mortgage amount, but for a lot of people, if the goal is to take a small mortgage just for the tax deduction, there's probably not even a tax deduction there. That's the first side. The next side of the equation, or the other side that we want to make sure we're looking at, is does it make sense to take any mortgage into retirement? Not for the tax benefits, but just because it's an extra expense. So there's a pretty simple equation when you go into retirement. It's, are you going to outlive your money, or is your money going to outlive you? Ideally, we want it to be the latter. We don't want to be put in a situation where there's more life left, but there's no more money left. How do you do that? Well, you keep your expenses within a reasonable range to which your portfolio can support those expenses, ideally at a sustainable rate over time. Now, as you're looking at this, it's pretty simple. The higher your expenses, the higher your chances of running out of money given some fixed level of assets or investments. A mortgage can be one of our highest expenses. So it's not necessarily bad to retire with a mortgage, but you have to look at your own situation. Is your mortgage amount so burdensome, so high, such a big amount that it could potentially leave you running out of money too early? If that's the case, it might not be a great idea to retire with a mortgage. Now, when you're looking at this, here's a simple framework that you can apply. In investing, there's general rules of thumb that you can use around how much money can you pull from your portfolio. There's a rule of 4% that says you can pull 4% per year from your portfolio. There's other things like guidance guardrails that say you can pull a little bit more. Say it's a number like 4 to 5%. Well, based upon your portfolio assets and based upon how much you need from your portfolio assets, can you take out money from your portfolio to pay for that mortgage and all of your other expenses without exceeding the withdrawal rates you want to come in underneath? If you look at that and say yes, well, then on paper, first glance at it, it's probably not such a bad thing to retire with a mortgage. If you have a portfolio that can easily support your mortgage payment and then some, it's not the worst thing in the world to take that mortgage into retirement. Now, if you look at that, it's the opposite of saying, okay, I have my portfolio, here's my expenses, which still includes a mortgage, and I'm going to need to take out a significant amount from my portfolio to cover the mortgage and everything else. And in fact, it's an amount that's above a sustainable withdrawal rate. That's where I would pause for a second and see, okay, what does this really look like? Is it going to be a significant amount above a sustainable withdrawal rate, but maybe only for a couple years until the mortgage is paid off? That's a whole lot different than someone who said, I just got a brand new mortgage, it's not going to be paid off for 30 years, and I'm having to take more money out of my portfolio than I can sustainably support over the course of my retirement. That person is going to have a much higher risk of running out of money than the person who temporarily has a higher withdrawal rate, maybe just in the first couple of years as they continue to pay that mortgage. So just using some simple examples here to say it's not a one size fits all. It really does depend, because someone who's going into retirement, let's assume that someone has a $3,000 per month mortgage. Well, one person goes into retirement with $500,000 in their portfolio. Another person goes into retirement with $5 million in their portfolio. Both have $3,000 per month mortgages. That doesn't necessarily mean that the same rule is going to apply to both of them. One of them has a lot more assets that can sustain a lot more expenses than the other. So it really comes back to understanding what are your total expenses with and without the mortgage, and is that sustainable based upon the portfolio balance that you have, as well as the other income sources you have going into retirement. So the biggest risks of the mortgage, in summary, I would say, is higher expenses. It simply puts more pressure on your portfolio to be able to generate this level of expenses. That's why you want to check in on your portfolio balance and the withdrawal rates. And then number two, sequence of return risk. So sequence of return risk is just the risk of what if you retire and your average return over the course of retirement is just fine, but the first several years of retirement you go through a terrible bear market. Well, if that's the case, there's some discretionary expenses that you can cut back on. Do you maybe push some of the more expensive travel? Do you maybe push some of the more expensive purchases, whether that's a car or redoing aspects of your home or whatever it is? You have some discretion with some areas of your life to help mitigate sequence of return risk. It just means, can we temporarily reduce some of these expenses? The mortgage is not an expense that you can temporarily reduce. The bank is going to want their monthly mortgage payment regardless of what's happening in the stock market. So just keep in mind that there is a little bit more sequence of return risk that you're potentially exposing yourself to if you maintain that mortgage, unlike other expenses that are more discretionary in nature that you can control to what extent you're paying for those. Now, this is just the financial side. I want to wrap up by saying for a lot of people, paying the mortgage off brings a tremendous amount of peace of mind. Even if it's not the right thing to do financially, even if they could retire with a mortgage and be just fine, it's not just about what makes sense financially, it's what's going to generate the highest level of peace of mind. What's going to generate that highest level of security and that confidence as you go into retirement. So it's not just what are the tax implications or what are the investment withdrawal implications. Ask yourself also, how would you feel retiring with a mortgage? How do you feel retiring without a mortgage? If you would be just fine either way and financially you could support it, there's nothing bad about retiring with a mortgage. It's just another expense. You just need to make sure that you can support it. But if there's something in there, and for a lot of people there is, to say, I would feel so much more confident to retire without a mortgage, don't ignore that either. Make sure it's not just the financial aspects, but also the non-financial aspects, the peace of mind side, that you give a lot of consideration to as well. If you're listening to this and saying, I don't have any idea how much my expenses will be in retirement before even the mortgage is calculated, check out this video above. It's going to give you an idea of how can you understand what your expenses will be in retirement, which is a great starting point as you look at your retirement plan. Thanks again for watching. This is James Canal with the Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think could find value from it. And also be sure to like this video and subscribe for more content like this. And if you want more resources about how you can create a secure retirement, be sure to check out our podcast called Ready for Retirement. And finally, if you're interested in seeing how our services can help you create a secure retirement, check us out at rootfinancialpartners.com.